This is Brent from wolfonwallstreettrade.com and our soon-to-be new website, thetechnicaltake.net. The last video I did was last weekend. It was called The Market Stranger Signals, and as of then, this is what the NASDAQ 100 looked like. I said I expected 2 more days of small-bodied candles like this within this big red body candle, and then something bearish to happen. So this is what's happened since then. 2 more small-bodied candles inside this big red day, and the NASDAQ 100 just dumped down 4% for the week. So we're going to dig in a little bit deeper, see where we're going from here. If you like this video, please give it a thumbs up. Don't forget to subscribe to the channel. Check out the website at wolfonwallstreettrade.com. And if you have any comments or questions, just leave them down in the comment section. I try to get to all those and answer them for you. So let's dive right in. What are the stranger signals? I have some volatility, some custom volatility indicators that don't give signals very often, but when they do, they're very high probability. So let's start there. First is the S&P and VIX positive 10-day correlation, these little yellow dots. Over here, Volmageddon, where VIX exploded over 500%. Over here, the COVID crash, a 35% decline. Over here, we have a top in the S&P 500 at an all-time record high, 2021, and a bear market over here. And then we had some very recent signals. I'll show you what they look like a little bit closer up. And this is the S&P 500. In this case, you can see the yellow hash marks where we have a positive 10-day correlation. These are pretty rare. I mean, we have not had one since before the bear market started in 2022. Right over here as the market was topping, you could see like a little head and shoulders. So we just started getting these again right here as we come into July. So that's one thing. This is what that positive correlation looks like on a 5-minute chart. What I've done is inverted the S&P. Usually the S&P and VIX move opposite each other. Typically what you would see is VIX in blue over here just trending down as the S&P makes all-time new highs. But we can see relative strength over here, and this is where we've just seen this huge move recently in VIX. I also use longer 30-day and 90-day correlations. Here's an example of a 90-day correlation. These are not like a scalpel. They're like an axe. Okay, so they're a blunt instrument as far as timing goes, but they do call out some interesting things. This is the great financial crisis. Okay, so it was calling out something unusual at the very top before the great financial crisis. Here's Volmageddon, where the S&P fell, I don't know, 12 or 15%, but volatility, the VIX index, exploded over 500%. Here's the COVID crash, a 35% crash in the S&P, and then we've just got a recent signal on the 90-day correlation as well. So this is saying something big is brewing, and that has led to this nasty price action. So we started getting signals in volatility on the 27th of June, and we get all this nasty price action the last couple of weeks. Here's a weekly chart of VIX, so you can see this last week, 32.6% gain, and since we got our first ABI signal on June 27th, we have seen a move close to close of about 35% in volatility in VIX. Those stranger signals really were telling us something was coming, and they're still telling us that something's coming, like that big 90-day correlation signal that we recently got. For the VIX index, go back to this weekly chart. This is the biggest surge in volatility in VIX in 10 months. So days after we get those signals and the ABI signals, or days after that, we're starting to see some really nasty action in the market. As a matter of fact, this is an actual excerpt from a subscriber post from July 8th, and you can see what I've highlighted here. Since 1928, July 17th has marked the local top for the month, heading into a materially lower August. So this was posted on July 8th. In the NASDAQ, here is the actual record high on July 10th, and here is July 17th. So pretty interesting, huh? So the week ended pretty ugly for the NASDAQ 100. It ended ugly for the S&P 500 as well. Not so much for small caps. So we're seeing rotation to small caps. They've been on a tear as we've seen the mega caps and NASDAQ come down. They are pulling back a little bit. Really, so far, small caps are still looking pretty good. We'll talk more about those. The troubling aspect when you look at indexes like the S&P 500 or the NASDAQ 100 that are coming down, there's not a lot of money on the sidelines, as you always hear. So CTAs, this is some of the big money that's in the market. CTAs are max long. As of July 16th, here's CTAs. They are at near record max long levels. They're all in. So that's the case with US equities. That's the case with global CTAs. Vol control funds, same thing. They're at or near max long. Hedge funds, their net exposure is above average. They are actually selling tech and AI to retail, so they are dumping their shares. Distribution is what I was talking about in last weekend's video. They're dumping their shares to retail, to mom and pop investors. And while we have seen some short covering, especially in small caps, bears have pretty much capitulated. There's not a lot of bears in the market. So let's jump back to the charts and see some other things that were popping up, such as key reversal days. So what has been running the market all year? It's been mega caps and semiconductors. A real bearish day over here with semiconductors, the Philly Sox index. We had a key reversal day. So we had a big bearish engulfing candle over here. Then we had a key reversal day. We had those 3 days. This is called a falling three methods candlestick pattern, and then dumped this week. So semiconductors, mega caps, all getting hit. We had a lot of these falling three method candlestick patterns. That's the 3 days inside this big red candle and then a dump. So we saw them in semiconductors. We also saw them in the NASDAQ 100, as you can see over here. We saw something typical, not exactly textbook because this wasn't a green day, but still in the mega cap index. And then the most heavily weighted and the most important sector in the market, technology, we saw something similar. Going back and looking at this semiconductor index, the worst day since, look at this, oh my lord, since the COVID crash, way back here. As far as the S&P and VIX 10-day correlation signal, that's typically something where when we get a signal like that, we'll see a 2 to 5% pullback in the market, like a correction, but it also has marked, some major tops. It's come at some major tops. What we got this week would probably qualify, to fulfill that signal. But what really interests me right now is this really strong 90-day correlation, which is really unusual. So we have it right over here. And as you can see, it marked the COVID crash, it marked Volmageddon, and it marked the great financial crisis back here. So the fact that we have one here, this 90-day, this is not a short-term signal. The absolute breadth index signal, which is this one that painted these bars yellow, typically, on average, we'll see a move in the VIX index of about 50%. But in 2018, when the S&P came down maybe 10 or 12%, we saw volatility or the VIX index explode over 500%. So that is another one that's kind of still lingering out there. I think there could be some room for VIX for volatility because I know some of you guys took some trades in volatility. By the way, let me know what you did, how you did it, and how you're doing with it. If you did trade volatility, I know there's a whole bunch of different ways to do that, and it's a kind of a tricky thing to trade. But let me know how you did. I think there could be a little bit more upside. So we just had the July options expiration, and it was the biggest July options expiration in history. So it was something like 2.7 trillion in notional worth of options that were expiring, and a lot of gamma came off with that. So that also means that the market will be able to move more freely, both up and down, than it has been. And then we also get into summer liquidity, which typically is diminished, which also can exacerbate price moves in either direction. So we could see some more gains in volatility. The question is, as we head into next week, what are we looking at? Is this move over for now? And when I say is this move over for now, that means like, do we get a bounce? Do we maybe fill this gap? So we're going to look at some assets and see what the price charts are looking like. When I look at NVIDIA, this is pretty much what I see. I see a level of support right here in this 118 area. So if that fails, I think we have problems. And this to me also looks like a little bit of a top. It's not really a well-formed like head and shoulders, but it's acting like one. So if you pull up volume, I'll show you what I mean by acting like one. Over here, we don't care at all really what's going on with volume. But as we get further into the right side of this pattern, it becomes really important. So I'm going to pull up the volume a little bit more. We're going to move to the right side of the pattern, and I'm going to show you what I'm talking about. So if we look to the right side of the pattern, volume is advancing on price advances. That's good, that's healthy, that's bullish. But as we get over here, look what volume's doing on price advances. It's going down, and then on price declines, the red volume over here, the sell side volume, is increasing. So again, over here on a price advance, we have like no volume. But on the decline over here, we see big red volume. That is acting toppy. That's not constructive behavior whatsoever. Now let's just look at some price action of some of the mega caps. We'll start with Meta. To me, this over here, it doesn't look horrible, but it's not bullish at all. So what I would probably look for is for price to come down and test maybe like this 460 area. Then maybe we get like a short-term bottom, a short-term oversold bounce. The market is not that oversold yet. And if we have time, we'll look at some 3C charts too. But Amazon, let's take a look at that real quick. So Amazon, last weekend, I was talking about distribution on 3C right up here at 200. You can see it in price. I mean, look at this square kind of top over here right at 200. So the price action, again, you know, coming down, bearish consolidation, coming down, bearish consolidation, coming down, bearish consolidation. Again, this isn't the worst. It's not as bearish as this stuff. Maybe we get a test over here or a test down here. It doesn't look fantastic either. Apple, another big one, right? And the price action over here in Apple, let me just zoom in a little bit to this. This price action doesn't look good. Again, it looks like, you know, a small intraday bear flag, the same thing. So you get a leg down, a bear flag, a leg down, a bear flag. Not great looking price action. Let's take a look at Alphabet. Again, not great looking price action. Maybe we get a test over here. I would say that's kind of like maybe best case scenario. Microsoft, that's another very important stock, and I pulled up something else. Let me just back this out a little bit. Again, we're seeing kind of a lot of the same kind of price action. It's not as bearish as it was a little bit earlier in the week or a week ago or so, but not looking great. I think we just looked at NVIDIA, so I don't know if there's much more. Yeah, so we're kind of getting a test right here in this 118 level for NVIDIA. For the semiconductors, stocks, there was some support here at 53.50, but it blew right through that, and that's where kind of the 50-day moving average was, so it blew through that. That's not great price action, obviously. You know what? Let's look at SMH. That's the ETF for the SOX index, because this is an index, so we don't have the volume on it, but SMH, and I'll pull up the volume. Give me a second. Okay, so this is the semiconductor ETF, and again, look at the volume here. I mean, look what's happening on the rallies. The volume is declining on the rallies, and then on the declines, the red volume is increasing. So again, over here on this rally, there's no volume here. And then on this decline, there's big volume. So this is not acting well. You know, when I see stuff like this, you know, price resistance, and I'm seeing big, heavy volume, this red sell side volume, this is all indicative to me of distribution. And that's something I went through in last weekend's video with 3C. So if we look at a stock like, let's look at NVIDIA. It's the most important stock in the world. First of all, if you back out and look at it, it's had this parabolic run. This price action over here looks either toppy or consolidative, but consolidative price action should really see volatility die down. You get a really tight area like this in price action, not these big moves like this. Looking at it closer, we have a key reversal day right here right? And this is this area that I think looks a little bit toppy, but that's a key reversal day. It's also a bearish engulfing. And then over here we get this little bounce, right? It doesn't make a higher high, so it's a bounce to a lower high, which is not a good thing in a price trend. And then we get another bearish engulfing day. Now, if this stock breaks below the 50-day moving average, I think all hell is going to break loose. In last weekend's video, I went over NVDA. I showed you my 3C, which has the power to contradict price, tracking underlying money flow, and what we were seeing was distribution. So here's 3C, and this is what it should be doing, confirming moving with price. Over here you can see it's even leading price higher, but we get up here to the top, it's negatively diverging, and then over here we have that bounce I talked about to a lower high. But look what 3C is doing, it's just coming unglued from price. That's distribution. We've also got the carry trade. So the dollar yen, you can look up the carry trade. Hedge funds, all kinds of big funds will use the carry trade to finance equities, right? They'll buy stocks with the profits they make on that. Now the carry trade is getting hammered because the Bank of Japan has just done nothing for so long, and the yen has just come apart. The yen is worth nothing and it's causing inflation. So now the Bank of Japan is stepping in, and I'm going to show you what's happening with the carry trade because it's having a direct effect on US equities. Okay, so what you're looking at is the dollar yen in the candlesticks, and the comparison in purple is NASDAQ 100 futures. I've rolled this chart back just a little bit so you can see how NASDAQ 100 futures kind of move with the dollar yen, the carry trade, right? Now I'm going to roll the chart forward a little bit and watch what happens when the Bank of Japan steps in and they support the yen, they knock the dollar yen down, and watch what happens to NASDAQ 100 futures. So here's the dollar yen getting hammered because the Bank of Japan intervenes, and here's NASDAQ 100 futures. Look what happens to them. Then they come in, they intervene again. Look what happens to NASDAQ 100 futures. So traders, hedge funds are getting hit on the carry trade, and they're having to close their US equity positions. So that's what we're seeing here. So you got to watch this as well, the dollar yen right now and what the Bank of Japan's doing. I think one of the big things, though, is going to be earnings season. And like I said in last weekend's video, the last two earnings seasons have been a tailwind for the market because expectations have been very low. That's not the case this earnings season. I have a graphic here for you. So here's the consensus view. The last two earnings seasons, it's been low. It's been going down. This earnings season, it's going up. So earnings season is not going to be easy for these top companies to beat. There's a higher bar. And over the next few weeks, we're going to start getting into the mega cap tech earnings. So my kind of view is that maybe within a week or so, we get some kind of oversold bounce and we start to try to fill some of the gaps that have been left in price. Let's take the NASDAQ 100 for example, because this is an area that I've kind of been watching right here around 19,500. There's like a little support here, and we're seeing price, come down and test it. This is an area I'm going to be watching real close next week, but you can see the big gap that we have right over here. So we have about the next 2 weeks or so, we start to get into the mega caps. What I'm kind of thinking is maybe we get a bounce up into that gap to try to fill that gap, because these gaps love to be filled. They're like magnets for price. And then we get into the mega cap tech earnings, and I have a feeling we're going to see something like a small head and shoulders over here in the NASDAQ, and then we're going to get into earnings and we'll see price come down. That's kind of my feeling about it because the bar is higher. And then we've also got apparent and obvious distribution going on in stocks like NVDA. Or look at stocks like Meta, what used to be Facebook. I can't stand calling it Meta. But again, like NVIDIA, we had really good 3C confirmation over here. Before price comes down, look what's happening. 3C is like negatively diverging into these price highs. Amazon had really good 3C confirmation moving along with price. It wasn't going anywhere special. It wasn't like a huge positive divergence. Get this flat over here in price at 200, and look what 3C's doing. I mean, it looks like distribution in price. It looks like distribution in 3C. Here's Alphabet, same kind of thing. 3C's confirming really well over here, but look what starts happening into these price highs. Distribution. So smart money sells into price gains. They don't want to sell into this because they're just going to drive price lower. They need demand. They need retail investors, mom and pop investors getting crazy and getting excited about buying. They want to sell into that demand. That's what we're seeing in all of these mega cap stocks. The one place that we're not seeing it is in small caps. As a matter of fact, we have a positive divergence over here, and you can see price running up higher. So we're seeing money come out of mega caps, money come into small caps, right? But as I covered in last weekend's video, we've seen this story before where mega caps run the show, they run the rally. All of a sudden, money starts coming out of the mega caps. It starts rotating into the small caps that have done nothing for 2 years, and then that rotation fails. So for like almost 2 years, while the NASDAQ 100 and the S&P 500 have been tearing higher and making all new record highs, what have small caps have been doing? They've been going sideways for almost 2 years until very recently. We move this chart forward and boom, they start to break out of this, right? If we take a little closer look, they're kind of starting to pull back a little bit. That's a 2-day chart. Let me give you a daily chart. So a nice big move, and there's good volume on it, right? You can see the good volume, some pretty heavy volume coming out, but it's declining, right? And price is coming down. So everybody's getting excited about small caps right now in this rotation. And I think maybe, there's more to go. We had a measured move for this up to 222.50, which was right in this area. It surpassed a little bit. The most common thing after a measured move is hit and surpassed is price comes back down to it or through it, which is what we're seeing right now. I think small caps may have some more upside to go. We have to really watch price action as we go forward. But this is the thing that happens all the time. The mega caps run the show, right? Small caps do nothing. They trade in a range. The last time this kind of happened was over here. Small caps led off the COVID crash. Then the mega caps came in. They did nothing for a year. They traded in this range. Then over here, the mega caps started to falter. There was this 2-week attempt at rotation into small caps. It failed. That led into the 2022 bear market. We've got a much bigger fractal of the same thing here, a 2-year range. Here's the attempted rotation. Same thing is back here. We'll see if it holds or not, but there's another example of it back here before the COVID crash. For almost a year of doing nothing but in a range, tries to rotate, tries to break out of that range, and then, here we come down again. There's even another example that I showed last weekend. So we see this all the time. I do not think this rotation is going to hold. Small caps really track with the most shorted index. This big move that we got off the October low here, off the bottom of this range, was all short coverings. Here's my most shorted index in white. Here's IWM small caps in the candlesticks. Here is that huge short squeeze. There were 5 major short squeezes. 3 of them were the biggest that we had seen in a couple of years. This one recently was huge. So if we take like a closer look, which I'll show you in a minute, you'll see how closely small caps track with these stocks that are being short squeezed. So regional banks, non-profitable tech, home builders, biotechs. There's just a group of kind of like the usual suspects. And what I said last week was that somewhere in this range, I think the shorts are going to run out of momentum. And they did. So here's a 2-minute chart of IWM small caps, my most shorted index. You can actually see my most shorted index starting to get squeezed and leading small caps higher. You can actually see this on 3C as well. Let me show you this little area right here where my most shorted index is starting to lead small caps higher. And I'm going to show you what 3C looked like right there. Positive divergence in 3C. That's as the most shorted index is also leading small caps higher. Over here we have a small negative divergence. It's not really that bad. It's typically what we see like in front of a consolidation. This is something we want to watch carefully because 3C is really starting to take a dive here Friday at the close. If we see this really come down next week, then we could see this rotation fail really soon. Right now, I don't see that happening yet, but these charts change every minute. So for my subscribers at Wolf on Wall Street Trade, this is stuff that I update all throughout the day as it's happening. The bottom line right now is what we're seeing is that rotation from mega caps to small caps, which looks like this. Let me just explain this real quick. It's a 15-minute chart. Here's the NASDAQ 100. Here's the last couple weeks of it coming down. And here's small cap IWM in blue. So as NASDAQ 100 is coming down, you can see small caps coming up. So you're just seeing money move from one area to another. If I normalize this chart, so everything from this left side will be in actual percentage terms. So let me just normalize it real quick. You can see what's happening here. So NASDAQ is coming down. Money's going into small caps. Does this rotation last? That's the question. In which small caps do nothing while mega caps lead. Then mega caps start to falter. Small caps try to break out. They fail. Same thing happened over here again, right? The breakout, the failure. And we're seeing a big version of the same fractal over here. And then on top of all of that, we have this very rare 90-day correlation signal, which has happened 4 times. One was Volmageddon, one was the COVID crash, one was the great financial crisis, and then again just recently. So I think this earnings season coming up for mega cap tech in the next couple weeks is going to be really, really important. So this video is getting a little long in the tooth. Sorry about that, but there's a lot of stuff out there. The carry trade, you gotta be watching that. If the dollar yen is leading markets higher or leading markets lower, we've got all kinds of things with earnings. We've got some really strange signals out there that we haven't seen. In some cases, in a couple years. In some cases, at major tops, at market crashes. I'm not calling for a market crash, but I do think we've got some stuff to navigate here, especially with this earnings season and election season coming up. So if you like the video, please give it a thumbs up and share it. Don't forget to subscribe. I'll post a link up here at the top of the video to last weekend's video because I think you need some context with a lot of these things I'm talking about. Members, I'll see you on Monday. Everybody have a fantastic rest of your weekend.